How does a promissory note work with your mortgage? Imagine signing a document that says you promise to pay back a loan for your house. That's what a promissory note is. It's a written agreement where you agree to repay the money borrowed. When you buy a home and get a mortgage, you sign this note. It spells out how much you owe, called the principal, and how much interest you will pay over time. It also states how often you will make payments, like monthly, and when the full amount is due, called the maturity date. The promissory note is your personal promise to pay back the loan. It is a legal document that makes your obligation clear. Without it, the lender would have no legal way to demand repayment. The note also shows the interest rate, which is how much extra you pay for borrowing the money. This rate can be fixed or variable, depending on your loan agreement. Alongside the promissory note, there is a mortgage or deed of trust. These documents secure the loan by putting a lien on your property. If you don't make your payments, the lender can start foreclosure proceedings to sell the house and recover the money owed. The promissory note and mortgage work together to protect both sides. The note creates the debt, and the mortgage secures it. When you close on your house, the lender keeps the original promissory note until the loan is fully paid. You usually get a copy of the note at closing. If you refinance or change your loan terms, a new promissory note is issued to reflect those changes. Without the note, the lender would not have a solid legal document to enforce the repayment. The promissory note also makes clear who is responsible for paying. Usually, only the person or people who sign the note are legally obligated. Sometimes, other parties may have an interest in the property, but they are not responsible for the loan payments unless they sign the note. Understanding how the promissory note works with your mortgage is key in real estate. It is the core document that binds you to the loan terms. It makes sure you are accountable for your payments. For investors or professionals, knowing how these notes work is helpful if they buy or sell loan agreements separately from the property. In summary, the promissory note is a written promise to repay the loan. It details the amount, interest, and schedule. The mortgage or deed of trust secures that promise by linking it to the property. Together, they form the foundation of your mortgage agreement and help ensure that everyone understands their rights and responsibilities.